So we continue the subsequent events, the discussion on the subsequent events. Subsequent events as per the ISA 560. Yesterday, I illustrated the key reporting dates that are very important. They define the auditor's responsibilities and the various audit procedures to be done with respect to adjusting and non-adjusting events. So let's now go through these notes right from the page 4, right on page 4. So subsequent events is 560. These are those events, whether favorable or unfavorable, that occurs between the balance sheet date and the date on which financial statements are authorized for issue. Then types of subsequent events: 1, adjusting events; then 2, non-adjusting events. So we begin with the adjusting events. Those events, whether favorable or unfavorable, that provides additional evidence of a condition that existed as of the reporting date of account. Adjusting events requires drafted accounts to be altered to accommodate them. Failure to adjust financial statements for adjusting events render the financial statements to be materially misstated. Then we have examples of the adjusting events: 1, bankruptcy of the debtors; 2, recovery of the debt previously thought to be bad debt; 3, payment of a major liability after the reporting date; 4, return of the goods sold; 5, discovery of the management fraud or error after the reporting date; then 6, significant decrease in the value of inventory. The next, we go to the non-adjusting events. Non-adjusting events. Non-adjusting events. So these are those events, whether favorable or unfavorable, that arise after the reporting date, but they do not provide additional evidence of a condition that existed as of the reporting date. They do not require drafted financial statements to be altered to accommodate them. Adjusting financial statements or non-adjusting events will render the financial statements to be materially misstated. So examples of the non-adjusting events: 1, issue of new shares after the reporting date; 2, changes in the foreign exchange rate; 3, mergers and acquisition after the reporting date; next, loss of non-current asset; stock due to flood or fire after the reporting date; next, government actions like privatization after the reporting date; next, changes in the nature of the business after the reporting date. Then you have the accounting for the subsequent events. So IAS 10, events after the balance sheet date, gives the following. So 1, adjust the financial statements for adjusting events. Then 2, do not adjust financial statements for non-adjusting events. Then 3, if the entity declares dividends after the reporting date, then the entity should not recognize this as a liability as of the reporting date, and thus it's a non-adjusting event. We have audit procedures with respect to subsequent events, what auditors can do with respect to subsequent events. So 1, the auditor should review procedures established by the management to identify subsequent events. Then 2, the auditor should read the meeting minutes of the shareholders, the board of directors, and executive committee in order to ascertain whether there is any subsequent events discussed. Next point, The auditor should inquire into the matter discussed in the company meetings where the minutes are not yet available. Then the auditor should review the interim financial statements of any subsequent events. 5, the auditor should inquire from the company lawyers all the pending cases that arose after the reporting date. Then 6, the auditor should also consider the effect of the subsequent events on the truth and fairness of the financial statements. Then 7, the auditor should ascertain whether the financial statements have been adjusted for adjusting events and whether adequate disclosures have been made for non-adjusting events. And next point, the auditor should assess the effects of the subsequent events on the entity's ability to continue as a going concern. Next point, the auditor should obtain management representation from the management that they have considered all the subsequent events known to them. Then 10, the auditor should inquire from the management any new commitment, borrowing, or guarantee by the company. The number 11, the auditor should inquire from the management where there is any sale or destruction of asset. Then 12, the auditor should inquire from the management whether there is any unusual accounting adjustments. Then you have the auditor's responsibility for subsequent events. This is done in accordance with those 3 reporting periods, the period 1 events, period 2, then period 3. So when you have events occurring up to the date of the auditor's report, the events occurring after the date of the auditor's report, the next period events is events occurring after the date of the auditor's report, but before financial statements is issued. Then number 3, events occurring after the financial statements have been issued. So we begin with the period 1. So the auditor shall perform procedures destined to obtain sufficient appropriate audit evidence that all the events up to the date of the auditor's report that may require adjustment or disclosure in the financial statements. These procedures should be applied in any matters examined during the audit, which may be susceptible to change after the year end. In summary, the auditor shall make inquiries for subsequent events up to the date of the report. Yes, yesterday we say this period, auditors have a responsibility to determine or to identify any subsequent events. They have an active duty to identify the subsequent events and perform the necessary procedures required. The number 2, events occurring after the date of the auditor's report, but before financial statements are issued. So here auditors have a passive duty. They have no responsibility to be aware of the subsequent events or to identify the subsequent events. So the financial statements are the management responsibility, and therefore the management should inform the auditor of any amount of subsequent events between the date of the auditor's report and the date the financial statements are issued. The auditor does not have any responsibility to perform procedures or make inquiries for subsequent events after the date of the report. However, if the auditor becomes aware of the fact that had been known to the auditor at the date of the auditor's report, he may have caused the auditor to amend the report, and then he shall, 1, discuss the matters with the management and those charged with the governance. Then 2, determine whether the financial statements needs amendment. 3, if amendment is required, inquire how management intends to address the matter in the financial statement. Then 4, if amendment is required in the financial statements and the management makes the necessary changes, then the auditor must carry out a number of procedures. The next, undertake any necessary audit procedures or the changes are made. Then B, extend audit procedures for identifying subsequent events that may require adjustment in the financial statements. Then C, provide a new audit report on the amended financial statements. Then point to note, if management does not amend the financial statements and the auditor's report has not yet been provided, the entity, the auditor shall modify the opinion and then provide the auditor's report. If the auditor's report has already been provided to the entity, the auditor shall notify the management and those charged with the governance not to issue their financial statements before amendments are made. But if the financial statements are issued, the auditor shall take action to seek it to prevent reliance on the report. Then the last one, we have the events. After the financial statements have been issued, the auditors have no obligation to perform procedures or to make inquiries regarding financial statements after they have been issued. However, if he becomes aware of any subsequent events during this period, he should discuss the matter with the management and consider the consequences of the effects of such events. So that will now bring us to the end of our discussion on subsequent events with regarding to the responsibility of the directors and auditors, then also being able to identify the various examples of the subsequent events, be it adjusting events or non-adjusting events, be able to understand the various procedures undertaken by the auditor or performed by the auditor when it comes to the review of subsequent events. So let's look at a question from the past paper. Let's have a look at a question from the past paper. So this question is on November 2015. November 2015. Question number 3. Question number 3. November 2015. Question number 3A. That's on page 58. November 2015. Question number 3 on page 58. November 2015, question number 3. Question number 3, part, sorry, the whole of the question number 3. The whole of the question number 3. So let me read the question. You are a member of the audit team assigned to audit the financial statements of A.A.A. Trading Company Limited, a listed company, for the year ended 31st August 2015. The detailed audit work was completed on Friday, 30th October 2015. The audit assignment partner has requested you to consider the auditor's responsibilities for identifying subsequent events and the audit procedures for examining subsequent events. With respect to the financial statements of A.A.A. Trading Company Limited, it is tentatively proposed as follows. 1, the audit report be signed on Tuesday, 12th November 2015. Then 2, the financial statements to be sent to the shareholders on Wednesday, 2nd December 2015. Then 3, the annual general meeting of the company be held on Wednesday, 30th December 2015, in which the meeting, the shareholders will vote to approve the financial statements. Then required, assess the responsibility of the auditors for detecting material subsequent events in the following periods. So 31st August 2015 to 30th October 2015. The next 30th October 2015 to 12th November 2015. Then 12th November 2015 to 2nd December 2015. Then 2nd December 2015 to 30th December 2015. Then B, explain the audit procedures that you could use in the examination of subsequent events. Then C, describe the work you will carry out for the period listed in A Roman 2 above. In A Roman 2 above. So the very first thing that you need to do is to identify those respective periods. So we have the reporting date, financial reporting date, the financial reporting date. Now, our financial reporting date, as per this question, the date when the financial statements are completed. It's 31st August 2015. This is 31st August 2015. Then you have the audit report date. The auditor report date. So the auditor's report date, you're being told to be on Thursday, November 2015. Then the date the financial statements are authorized for issue. The issue of financial statements. And this date is a date of 2nd December. Of 2nd December 2015. Then the last one, you have the date for the AGM. AGM date. And the AGM date has been fixed to be 30th December 2015. 30th December 2015. So those are the key reporting dates. So what happens between what assess the responsibility of the auditor for detecting material subsequent events in the following period: 31st August to October. 31st August to October. Then 30th October to 12th of November 2015. Okay, so the question for that answer is what we have down there. So the answers for that question, we have it down there. So between 31st August to 30th October, auditor should make an inquiry for any amount of subsequent events. Yes, this period here, auditor has got active duty to make inquiries to identify any subsequent events. Active duty, yes, I to say auditor has got active duty to make inquiries. Upper, no duty, passive duty. Here also the passive duty, the passive duty. So on that particular date, 31st August 2015 to 30th of October 2015, the auditor should just make an inquiry for any identified subsequent events. So auditor have got a duty, they have an active duty to make those inquiries to identify subsequent events. Then on the date of, between the reporting date, between, not before the reporting date, but between the date of the financial reporting and the date of the auditor's report. Again, auditors still have got an active duty of making inquiries to identify subsequent events. Make inquiries to identify subsequent events. And you may also consider the implication on the financial statements of such identified subsequent events. So that period, auditors need to perform the necessary audit procedures to identify the subsequent events. The next one, the date of auditor's report and the date when the financial statements have been issued. So their auditor have got no responsibility of identifying subsequent events. Then the last one took on between 2nd December to 30th December. Again, there, auditor have got no responsibility of identifying subsequent events. However, if it comes to their attention, they may consider to have a discussion with the client's management and perform the necessary auditor procedures. Then Part B requires you to identify those procedures undertaken by the auditor with respect to examination of subsequent events. Then Part C, describe the work you will carry out for the period listed in A Roman 2 above. So that's period 1 events. So what do you do on period 1 events? In period 1 events, on period 1 events, their auditor have got active duty to identify subsequent events. And for that case, they have to undertake certain audit procedures of identifying subsequent events. So that question just requires you to identify some of the procedures undertaken by the auditor and the first stage, which is the date when the financial statements are complete and the date of auditor's report, what procedures are undertaken by the auditor. And you can be guided by, on page number 6, on the first item there, on the responsibility of the auditor on subsequent events for those occurring up to the date of auditor's report. Like there, the auditor shall perform procedures procedure designed to obtain sufficient appropriate auditor evidence that all events up to the date of auditor's report that may require adjustment or disclosure in the financial statements. These procedures will be applied to any matters examined during the audit, which may be susceptible to change after the year end. So the auditor will make inquiries for the subsequent events up to the date of his report. So we can bring that one to an end on subsequent events. So our next we go to the management representations. The management representations. The management representations. So on the management representation, we shall begin our discussion on what we call the financial statement assertions. Financial statement assertions. Financial statement assertions. So whenever managers are preparing the financial statements, They are expressing the economic conditions of the farm in either financial or non-financial terms. A collection of those expression statements are known as the financial statements assertions. Those assertions are either expressed or implicit, and they are inbounded in the financial statements. So your work as an auditor is to verify the validity of the management financial statement assertions. Whenever you've been employed to evaluate or review the validity of the financial statement assertions, you are undertaking what you call attestation engagement. You are undertaking what you call attestation engagement. Yes, attestation engagement. Which your work is now to confirm whether a particular financial statement assertion is right or it is wrong. It is correct or it is incorrect. So we have these various assertions. For example of the assertions, examples of the assertions, We can use a mnemonic word here, what you call the SCA cover, ACCA cover, ACCA cover, to identify this particular assertion. ACCA cover, SCA cover, where the first A here stands for the accuracy assertion. Yes, that is a confirmation that the transactions and the events pertaining to the entity are accurate. The managers are saying that yes, the transactions and events in relation to the entity have been accurately entered and posted in the relevant books of accounts. The next we have a C here, what we call classification. Classification assertion. So the managers are expressing themselves that the transaction and the events pertaining to the entity have been classified in the correct classes of accounts. The next we have assertion with respect to what we call the cutoff. So managers are asserting that the transactions and the events pertaining to the entity have been entered into the correct accounting period. They've been posted into the respective correct accounting period. The next we have what we call the allocation. Assertion with respect to allocation. So they are confirming that the balances regarding the entity have been allocated in accordance to the standard requirement. The next one, completeness. So on the completeness, they are confirming that the transactions and events, including the balances, are complete in all aspects. Every detail that ought to have been recorded have been entered into the books of accounts. The next we have the occurrence assertion. So they are confirming that the transactions and events pertaining to the entity actually took place. They did occur. The next is the valuation assertion. So all the valuation, they are confirming that the balances with respect to the assets and liability have been appropriately valued in accordance to the accounting standards. The next we have existence assertion. They are confirming that the balances that have been posted in the books of accounts actually do exist. Those assets and the liability balances actually do exist. Then the last one, rights and obligation. Rights and obligation assertions. Rights and obligation assertions. The rights and obligation assertions. Managers are confirming. Rights is in relation to the assets of the entity, then obligation in relation to the liabilities. The liabilities, obligations in relation to liabilities. So all the rights here, the managers are confirming that the assets appearing in the books, the entity do have a beneficial ownership over them. The assets appearing in the books, the entity do have a beneficial ownership over them. Then the last one here we have the obligation. They are confirming that the liabilities appearing in the books, the entity do have an obligation over them. So these are the various assertions normally examined or reviewed by the auditor to be able to express a certain level of assurance. So we're here going to take the valuation from the valuation here. That valuation, existence, right, and obligation. Then we add completeness. We add completeness. We add completeness here. Assertion with respect to completeness. These are part of the assertion with respect to balances. Assertion with respect to the balances. Assertion with respect to the balances. So the balances assertions are valuation, existence, rights and obligation, then completeness. So the ratio, if we remove this allocation, out of this particular list, whatever is remaining here, whatever is remaining here, are such with respect to what you call transactions and events. Assertion with respect to the transactions and events of the entity. The transactions and events of the entity. Then the last category, we have the assertion with respect to presentation and disclosure. So let's now go through our notes there from page 7 on management representation. So where the managers make representations pertaining to the assertions. So before the auditor signs the auditor report, he should obtain management representation directly from the management of the company. Management representations are the assertions made by the management with respect to assets and liabilities. The following are the main assertions with respect to financial statements. 1, existence. B, measurement. C, valuation. D, rights and obligation. Next are completeness. Next we have presentation and disclosure. Next are cutoff, then ownership. So on number 1, existence. This is a representation by the management that assets presented and recorded in the financial statements actually do exist. It is an assertion that as of the balance sheet date, assets and liabilities reflected in the statement of financial position actually existed, and they relate to the entity. In order to confirm or verify his assertion, auditor use procedures such as checking the position to the ledger, making inquiries, reviewing invoices and the support documents, etc. Then to kuna hiyo ya measurement, though not part of our HCA cover. So measurement, this representation by the management that assertions pertain to assets and liabilities have been recorded in the financial statements on the appropriate amount and in accordance with the relevant policies and procedures. It is an assertion that as of the balance sheet date, transactions and the balances pertaining to the entity were recorded at their correct values. The auditor should also ascertain this assertion by performing procedures such as recalculation, inspection, consultation with the management etc. The next we have the valuation. This is an assertion by the management that the assets have been recorded in the financial statements at their appropriate values. It is an assertion that as of the balance sheet date, the value of the assets, liabilities, incomes, and expenditure were reflected at their appropriate carrying amounts, meaning that suitable accounting policies were used by the client company to value them. Auditors should also determine the stability of the accounting policies commonly adopted. Auditors will use procedures such as inspection of assets, review of the financial statements, consultation with experts, reperformance of the company policies relating to valuation. So valuation is normally a function. Valuation is normally a function of like 4 components. So whenever auditors are performing the valuation verification, it is a product or a function of certain components. So one, the historical cost of the asset is considered, the historical cost of the asset, like being able to examine or inspect the purchasing documents, the purchasing documents or the purchaser receipts. The other one is with respect to what we call the additions. Confirming the minutes of the board of directors if there was any approval for the purchase of that particular asset. There is also with respect to disposal or disposal procedures. Then the last one is maybe revaluation. Revaluation. And you can't also forget talking about depreciation. Depreciation. So those areas are normally considered when it comes to the valuation assumption, confirming the historical cost, the addition of those particular assets where they were at a fair market value, the disposal, was the disposal authorized, was it also done in accordance to the fair market value, the revaluation, was the revaluation performed by an independent valuer, someone who is qualified and competent to do the job. Then the depreciation, check the policy used, how was it consistently applied, what about the rate of the depreciation, is it reasonable and appropriate. The next we go to rights and obligation. This is a representation by the management that the company has the rights over its assets and that the liabilities are the obligation of the company. It is an assertion that all the assets reflected in the financial statement position were genuinely owned by the company and that liabilities outstanding were genuine obligation to the company. The auditor should use different procedures to verify this assertion, such as inspection of title deed, logbooks, invoices, suppliers' statements, etc. Then incompleteness. This is a representation by the management that all assets and liabilities and transactions that should be recorded have been recorded in the books of accounts and that the financial statements. It is an assertion that transaction and balances in the client system of accounting are complete, meaning that there are no omission or missing items. The auditor performs sequence checks, especially pre-numbers, documents tracing of missing items, reperforming calculation in order to confirm this assertion. The next representation and end disclosure. This is a representation by the management that assets and liabilities have been presented in the financial statements and that adequate disclosures have been made in accordance with the generally accepted accounting principles and relevant financial reporting framework. The next cutoff as of the procedures. Cutoff test as to the procedures. It is a representation by the management that transactions have been recorded in the correct accounting, period. In the correct account and then relate to the correct accounting period. The auditor should perform procedures such as circularization, re-performance, etc. The next we have ownership. This is a representation by the management that the assets and liabilities presented in the financial statements relates to the company. The auditor should inspect documents such as title deeds, vouchers, etc. So then we have the management representation letter. This letter is normally written by the auditor, but on behalf of the management, it is supposed to be written by the management. But since auditor knows areas to be confirmed or items to be confirmed, it is the auditor who normally draft this particular letter. They shall request the senior officers in the client company to have this letter signed by them. So this letter is supposed to be written by the management, but traditionally it is the auditor who draft the management representation letter and request the client senior officers to sign the letter, like the chief executive officer, the chief operation officer, etc. can be requested by the auditor to sign the letter as a confirmation that they do confirm the matters contained in this particular letter. This letter provides valuable evidence to the auditor, and it is a requirement from the managers should provide this letter to the auditor on the completion of an audit. It confirms some of the verbal discussion which took place between the auditor and also the client. So this letter is drafted as per the ISA 580, which provides the guidelines in terms of the content of writing this particular letter. It also communicates the importance of this letter when it comes to conducting an audit. So auditors are normally required to obtain sufficient appropriate evidence. There are those evidence which auditors can be able to apply their procedures and conclude. Then there are those evidence which auditors are not able to apply procedures and to be able to conclude. However, they can engage an expert to do certain work for them and give them that evidence as a basis of their auditor opinion. Then there are those cases whereby the evidence auditors are able to perform the necessary auditing procedures and the tests required. And for that case, we now take the responsibility to the management to provide that sufficient, appropriate evidence. So one of the way the managers will be giving the evidence to the auditor is through what we call the written management representation letter. So in this area, we are required to have knowledge on how to draft a management representation letter. That means company must be very well versed with the contents of this particular letter. Examiner can ask you to draft a management representation letter. And the only way of doing it is being able to understand some of the essential contents of this particular letter. So let's continue from page 9, the management representation letter. So this is a letter written by the management to the auditor as acknowledgement of the management responsibility to prepare financial statements that gives a true and fair view. This letter should be provided to the auditor ordinarily after the completion of the audit, but before signing the auditor report. The management representation letter is one way of documenting the oral representation earlier obtained by the auditor from the management, hence providing a reliable auditor evidence. Purpose of the management representation letter. So one, acknowledgement of responsibility. This letter enables the management to acknowledge their responsibility to prepare financial statements that give a true and fair view. Then two, documentary evidence. This letter provides documentary evidence to the auditor on matters which oral representations do not constitute sufficient appropriate auditor evidence. Then form management declaration. This letter enables the management to make a written declaration pertaining to the financial statements, such as based on our knowledge, the financial statements are true, fair, and reliable. Then for confirmation of oral representation. This letter enables the auditor to obtain management confirmations on oral representations earlier obtained by the auditor from management. Then 5, the basis of opinion. This letter provides the basis of expression of an opinion on the financial statements. Failure by the management to give this letter to the auditor form the basis of expressing a qualified opinion or a disclaimer of opinion on the grounds of the scope limitation. On the grounds of the scope limitation. And next, we go to the contents of the management representation letter. The contents of the management representation letter. So one, acknowledgement by the management of the responsibility to prepare financial statements that give a true and fair view. Then two, confirmation of completeness of information in the financial statements. Then three, declaration by the management that there are no irregularities in the financial statements or employees. Then four, nature of contingent liabilities affecting the entity at the reporting date. Then four, confirmation of the company compliance with the requirements of the account and other legal requirements. Then six, confirmation of consistency in the application of accounting procedures and principles. Then seven, confirmation that all the information and explanation requested have been provided. The number eight, confirmation that all liabilities and provision have been disclosed in the financial statements. The nine, confirmation of existence of assets. Then the last one, confirmation of evaluation of assets and liabilities. Then you go to signing of the management representation letter. This letter should be signed by at least two senior officers of the client company. The following are the reasons for signing this letter. One, to ensure that the directors are liable of any misleading given to the auditor. Yes, to ensure that the directors are liable for any misleading information given to the auditor. To ensure that the directors are liable for any misleading information given to the auditor. Then B, to commit the management of the company to the matters of accuracy, valuation, and completeness of records. Then to ensure that the management appreciate their responsibility of preparing financial statements. So what happens when the managers refuse to sign this letter? So refusal by the management to sign management representation letter. So sometimes the management may be reluctant to sign this letter. The following are some of the reasons why they can refuse to sign the letter. So one, if they do not understand their responsibility of signing the letter. Two, if they have some reservation on some parts of the accounts. Then three, if they are uncertain about a given matter whose outcome is yet to be ascertained. The next, where they do not want to cooperate with the auditor. So action by the auditor where the management fails to sign the representation letter. So one, the auditor should remind them of the need and importance of this letter. Two, the auditor should inform the management the consequences of not providing the letter. Then three, consider the materiality of the matter over which representation is required. The next, consider drafting the letter personally based on the oral representation earlier obtained from the management and give them for confirmation, approval, and signature. Then qualify the audit report qualify the auditor report by expressing a disclaimer opinion on the grounds of the scope limitation, where the management refuses to provide and sign the letter. So that's all on the management representation as per the ISA 580 on matters pertaining to writing the letter and the contents of that particular letter. So maybe we need to just have a look at a sample of a management representation letter before we proceed now to those areas of auditing the financial statements, accounts items for the group entities. So Kwanzaa, you can check this question. You can check this question on May 2021. May 2021, question number 4A. 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 So check that question on May 2021. Your question number 4. Your question number 4. So let me read the question. You are the auditor. You are the auditor of Tamba Mattresses Limited, a company involved in a bulk production of mattresses for the sale to individual consumers. The company's year end as 31st December 2020. Assume further that the following information has just been availed to you before the audit report is signed. The springs in a new type of mattress have been found to be defective, making the mattresses unsafe for use. There have been no sales of the type of mattresses. It was due to marketed in the next 4 weeks. The company insurers estimate that inventory to the value of 75 million shillings have been affected. The insurers also estimate that the mattresses were now only worth 22.5 million. No claim can be made against the supplier of the springs, as the suppliers are in liquidation with no prospect of any amounts being paid to third parties. The insurers will not pay Tamba Mattresses Limited the reduction in value of the inventory as the company was under-insured. All of this inventory was in the finished goods store at the end of the year, and no movements of the inventory have been recorded post the year end. Then required, with reference to the applicable international standards on auditing, number 1, determine whether the above event is an adjusting or non-adjusting event. Then Roman 2, discuss the auditor's responsibility and the audit procedures and action that should be carried out in the above scenario. So class, what do you think on that event? Is it adjusting or non-adjusting events?
So, in
What do you think, class? Is that one adjusting or not adjusting events? What do you think, class? Is that one? Okay, nani anasema Rose and Victor saying adjusting, but they're not providing a reason why it's adjusting or not adjusting events. So what could be the reason why it is adjusting or non-adjusting events? So no any further explanation. Yes, which is saying that the mattresses are unsafe to use. There is also issue on valuation of insurance. There was a reduction in the inventory was in the store at the end of the year. Okay, so let's write the following. Yes, I agree with you. It's adjusting events. It do provide a condition which existed as at the balance sheet date or at the reporting date. And if you consider the value, there is a quite material which requires the financial statements to be amended. So determine whether the above event is adjusting or non-adjusting. So the event is adjusting. The event is adjusting. The event is adjusting since the mattress inventory. The event is adjusting since the mattress inventory provides additional evidence of condition, provides additional evidence of condition existing at the end of the reporting period, at the end of the reporting period, at the end of the reporting period, at the end of the reporting period. As the inventory was in existence, as the inventory was in existence, as inventory was in existence, and the faulty springs were included. And the faulty springs were included. And the faulty springs were included in the inventory at this time. In the inventory at this time. The value of the inventory is overstated. The value of inventory is overstated, and the financial statements needs to be adjusted. And the financial statements needs to be adjusted in accordance with the IS2. In accordance with the IS2. In accordance with the IS2. So then we go to part Roman 2 of the question. Discuss the auditor's responsibility and the audit procedures and action that should be carried out in the above scenario. So what are the auditor's responsibility and the various procedures in the above scenario? So this matter is adjusting events. The period when it has just been discovered is before the audit report is assigned. So before auditor's reporting date, for that case, auditor has got a sole responsibility to undertake inquiries to identify subsequent events. These are those procedures that auditors will undertake with respect to this identified subsequent event. So we shall say that the auditor has a responsibility. The auditor has a responsibility to make inquiry. The auditor has a responsibility to make inquiry. The auditor has a responsibility to make inquiry with respect to subsequent events. With respect to subsequent events. With respect to subsequent events. The audit procedures to be performed include 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 so one. Number one, inspecting documentation from the insurance firm, inspecting documentation from the insurance firm to confirm the status of insurance claim. To confirm the status of insurance claim. Next, making inquiry to the company lawyer. Making inquiries to the company lawyers. Making inquiries to the company lawyers. To confirm if the company will be refunded. To confirm. Sorry, to confirm if the company will refund their customers. To confirm if the company will refund their customers for the losses incurred. For the losses incurred. Next, obtain an amended financial statements from the management. Obtain an amended financial statements from the management. Obtain an amended financial statements from the management pertaining the valuation of the mattresses inventory. Pertaining the valuation of the mattresses inventory. And next, review inventory list. Review inventory list. Review inventory list to ensure that defective springs. Defective springs are no longer used by the company. Defective springs are no longer used by the company. Next, obtain written management representation. Obtain written management representation regarding the inventory items. Regarding the inventory items. Next, assess the implication. Assess the implication of the inventory matter arising. Assess the implication of the inventory matter arising in the audit report. Assess the implication of the inventory matter arising in the auditor report. So those are the various procedures that shall be taken by the auditor with respect to that subsequent event matter. So let me share with you a copy of a management representation letter so that just have a look at it on how it's normally drafted, how it can be drafted on some of the essential parts of the components of the letter. So here we have a sample of a representation letter, a sample of a representation letter. So it will have the letterhead of the client entity. Then it's being addressed to the auditor. The date is there. That this representation letter is provided in connection with your audit of the financial statements of ABC company for the year ended 31st December. That for the purposes of expressing an opinion as to whether the financial statements give a true and fair view, are presented fairly in all material respects, in accordance with the specified the applicable financial reporting framework. We confirm to the best of our knowledge and belief, having made appropriate inquiries to be able to provide our representation. That one, financial statements. So this one up, we acknowledge and understand our responsibility for preparing and presenting the financial statements and believe that the financial statements are prepared in accordance with the applicable financial reporting framework. Our selection and application of accounting policies is appropriate. All plans or intentions that may materially alter the carrying value or classification of assets and liabilities in the financial statements have been accounted for or disclosed in accordance with the applicable financial reporting framework. All liabilities, both actual and contingent, have been recorded and, where appropriate, disclosed in accordance with the applicable financial reporting framework. The next, the entity has satisfactory title to or control over all assets disclosed in the financial statements, and where appropriate, all liens or encumbrances on these assets have been disclosed in accordance with the applicable financial reporting framework. We have complied with the aspect of the contractual agreements that could have a material effect on the financial statements, and instances of non-compliance have been disclosed in accordance with the applicable financial reporting framework. All transactions have been recorded, that they're confirming completeness there. Significant assumptions used by us in making accounting estimates, including those measured at fair values, are reasonable, is a 540. Okay, all events subsequent to the year end for which the applicable financial reporting framework requires adjustment or disclosure have been adjusted or disclosed. So next, the effects of the uncorrected misstatements are immaterial, both individually or in aggregate to the financial statements as a whole. A list of uncorrected misstatements is attached to the representation letter. Then internal control. So they measure something after the financial statements, responsibility, they go to internal control. We acknowledge and understand our responsibility for the design, implementation, and maintenance of internal control relevant to the preparation and presentation of financial statements that are free from material misstatements, whether due to fraud or error. And we believe that internal controls have been maintained is adequate for that purpose. The next, we have completeness of information. All records, documentation, and usual matters of which management is aware and other information relevant to the audit have been made available to you. We have disclosed to you the results of our assessment of the risk that the financial statements may be materially misstated as a result of fraud. We have disclosed to you all information in relation to fraud or suspected fraud that we are aware and that if that affects the entity and involves management, employees of significant roles in internal control, or others where the fraud will have material effect on the financial statements. We have disclosed to you all the information in relation to the allegation of fraud or suspected fraud affecting the entity's financial statements communicated by employees, former employees, analysts, regulators, or others. We have disclosed to you all non-actual or possible non-compliance with laws and regulations whose effects should be considered when preparing financial statements. Then the letter has to be signed by two persons, senior officers in the client company. So they will sign there, mean that they own that letters are content. So that's a sample of a representation letter. You can see the key areas, financial statements, then internal control, then the matters to do with the completeness of information. So let's take some 5 minutes break. Then when you come back, we check one question on the representations. So let's look at this question. Question up on pilot paper, December 2021, pilot paper, December 2021, pilot paper, December 2021, pilot paper. On question number 4, question number 4 and question number 5. Question number 4 and question number 5. That's on page 16. On page 16. On page 16. Question 4 and question 5 on page 16. So you are the manager in charge of the audit of Munop Limited. The following issues have arisen. So 1, a customer is suing the company for shilling 600 million for damage caused to their products in transit. The company is defending the claim and believes that the products were not the responsibility of the company, as the goods had been delivered to an independent transporter. Then 2, the balance due from Moronjiwa Limited in respect to the subcontract work shillings, 3 million shillings has been outstanding for over 6 months. Your farmer has been asked by the accountant not to write to Mronjiwa Limited for direct confirmation of this amount, as the latter company object to such letters. You have been assured by the accountant that the relationship between the two companies is good and that the outstanding balance will be paid. So required. For each of the above issues, A, state with reasons the audit work that you expect to find in undertaking your review of the audit working papers for the year ended 31st December 2021. Then part B, draft the relevant sections, including with these issues of the written representation letter you would wish the directors to sign. You would wish the directors to sign. So beginning the part A, state with the reasons the audit work that you will expect to find in undertaking your review of the audit working papers for the year ended 31st December 2021. So what will you expect to find when you are reviewing the audit working papers with respect to those particular matters? What do you expect to find? So plus, what do you expect to find as you review the management representation letter? We are silent on that. Tumekuwa hapo sasa. Rosa anasema I think the goods in transit are still under the seller. Still under the seller. Okay. So, okay. So one is a confirmation with a company lawyer. A confirmation with a company lawyer. A confirmation with a company lawyer about the possibility of the matter, about the possibility of the matter, about the possibility of the matter on the damage caused to the products in transit, on the damage caused to the products in transit, about the possibility of the matter on the damage caused to the products in transit for compensation, for compensation. The other one is presentation and the disclosure. Presentation and the disclosure. Presentation and the disclosure. Presentation and disclosure regarding the goods in transit. Regarding the goods in transit, damages. Next, inquiry on the provisions set aside. Inquiries on the provision set aside. Inquiries on the provision set aside for the compensation in the event of claims, for the compensation in the event of the claims. The other one is the adequacy and reasonableness. Adequacy and reasonableness. Adequacy and reasonableness of the provision amounts set aside. Of the provision amounts set aside. Of the provision amounts set aside. The other one is the procedures of establishing claims. Procedures of establishing claims. Procedures of establishing claims with respect to damaged products on transit. With respect to damaged products on transit. The other one is an inspection on the future liabilities, or an inspection on the past liabilities, an inspection on the past liabilities, an inspection on the past liabilities. If any, an inspection on the past liabilities, if any. And how they were, and how the matter was resolved by the management. And how the matter was resolved by the management. Next, any commitment by the independent transporter. Any commitment by the independent transporter to compensate for the damages caused. For the damages caused. The other one is a confirmation of the board minutes. A confirmation on the board minutes on the appointment of the independent transporter. of the appointment of the independent transporter. Next is authorization procedures for writing of a bad debt. Authorization procedures for writing of a bad debt. Authorization procedures of writing off a bad debt. Next, a documentation of the external confirmation replies obtained. A documentation of the external confirmation replies obtained, providing a reliable audit evidence. A reliable evidence on the outstanding balances to be paid. On the outstanding balances to be paid. On the outstanding balances to be paid. Next, an inspection if the subcontract work do exist. Sorry, an inspection if a subcontract agreement do exist. An inspection to confirm whether the subcontract work agreement do exist. So those are some of the matters, areas that you may find documented for the purposes of review to be able to obtain sufficient auditor evidence. Then part B, you are being required to draft the relevant section dealing with these issues of the written representation letter you will wish the directors to sign. So a draft of the representation letter. So that representation letter, what will it be having? Like one, it must have the part of the financial statements, where managers are confirming their responsibility to prepare the financial statements in accordance with identified financial reporting framework. There must be that part of their confirmation that the financial statements estimates are reasonable and appropriate. There will be a confirmation that they're using appropriate accounting policies. They're using appropriate accounting policies. The other part will be with respect to contingent liabilities, heading on contingent liabilities, like the creation for the provision of contingent liabilities, creation for the provision of contingent liabilities. The other matter will be a confirmation on the status of the liability and the breach of the contract from the company lawyers. Then you may also consider the other matters section, other information section, on what can be included in that particular section, on other matters section. So maybe I can give a comprehensive answers for that part B, next class when we meet on Friday, on a very clear answers on a sample written representation letter. So even your question 5, we shall do it in our next lesson on Friday. It's all about also the representation letter. So the management letter, drafting management letter, that one we can do in our next lesson on Friday. So let's end there for today. Then we shall continue from there on Friday.